Debt of almost every kind has seen an increase in recent years, and many people have embarked on debt-free journeys to prioritize paying down that debt as quickly as possible. At the same time, we know that investing in the stock market is one of the best ways to gain sustainable wealth, and the sooner you get started investing, the better. So what should you actually prioritize? Paying down debt or investing? In today's video, I'll be giving you some key considerations to think of so that you can answer this question for your own personal situation. So let's get started. Before we can even begin to properly address the question of whether you should pay down debt or invest, you need to make sure that you have a solid financial baseline established. Debt or no debt, you should make sure that you have an emergency fund saved up, because without this safety net, a financial emergency could completely set you back. An emergency fund is savings that you use in the case of an unexpected financial situation, such as sudden job loss, large medical or dental bills, major home repairs, and so on. An emergency fund is not to be confused with sinking funds. The primary difference between an emergency fund and a sinking fund is the reason behind your savings. A sinking fund is for planned future expenses that you know the cost of ahead of time, like a wedding or vacation, for example, while an emergency fund is strictly for expenses that you cannot anticipate. General guidance suggests to save up between 3 to 6 months worth of expenses for your emergency fund. And if you need help determining what exactly that number is for you, then click the link in the description box below to grab a copy of my free emergency fund calculator template, which is available for download both through Google Sheets and Excel. To level up your emergency fund, I recommend keeping your savings in a high-yield savings account. A high-yield savings account is a bank account that offers 20 to 25 times the national average interest rate of a traditional savings account. And most of the time, banks that offer high-yield savings accounts are online banks, and since they don't have large overhead fees, they are able to provide customers with higher interest rates. I have other videos on my channel where I talk in detail about what high-yield savings accounts are, and I also give you my top 5 options for banks of where to open a high-yield savings account. So make sure you check those videos out after you're done watching this one. Once you have an emergency fund squared away, then you can begin to tackle the question at hand of whether to invest or pay down debt, and you'll want to consider these 3 things. The first thing you'll want to consider is your own financial goals. So money is very personal, and how you choose to attack the situation is completely dependent upon what you value. So some people are at one extreme where they're very committed to their debt-free journey and paying down their debt as quickly as possible, working a side hustle to gain additional income to throw at their debt so that they can clear it quickly. And for these people, debt is something that they consider to be a very heavy burden on themselves, and they want to lift off of themselves as soon as possible, and I would say rightly so. But still, you have some people who are at the opposite end who want to be part of the FIRE community, which stands for Financial Independence, Retire Early. So the goal for these people would be to invest as much money as possible. So many people, I think, will actually fall somewhere in the middle of the spectrum, where you may have debt that you want to pay off, but you also want to have a sizable portfolio at retirement. So if that's you, you'll want to consider point number 2, which is your age. Your timeline for retirement, aka how old you are, is an important decision factor in choosing whether to invest or pay down your debt. This is because your age impacts an important decision factor, which is compound interest. Compound interest is the interest that you earn on your interest, and it is really the driving factor of growth in an investment portfolio. The younger you are when you start to invest, the more you can take advantage of compound interest working in your favor over time to grow your money exponentially. Let me give you an example using realistic numbers. Assuming an average stock market rate of return of 10%, if you invest $500 per month, which is $6,000 per year, starting at age 24, over the next 41 years, when you finally reach age 65, your portfolio will be worth around $3 million. But if you invest that same $500 per month, or $6,000 per year, starting just 10 years later at age 34, your portfolio value would decrease to be worth about $1.1 million by the time you are age 65. So you can see your timeline for retirement is a really important factor to keep in mind when you're making the decision of whether to invest or pay down debt. Because if you're further away from retirement, then you can maybe afford to hold off a little bit longer to start investing. But the closer you get to retirement age, the more you'll want to consider prioritizing investing so that you can take advantage of compound interest. This brings me to my third point, which is interest rates. I would argue that the most important number to know when you're considering whether to pay down your debt or invest is the interest rate of your debt. And the interest rate of your debt is highly dependent upon the type of debt that you carry. So if you haven't already done so, I would recommend listing out each one of your debts one by one, along with its corresponding interest rate. And in general, credit card debt tends to have the highest interest rates. So if you carry credit card debt, you may want to consider pausing on prioritizing investing so that you can prioritize paying off your credit card debt as quickly as possible. And this is also because the fines for missing a credit card payment tend to be pretty high, and not to mention it also negatively impacts your credit score. So as much as possible, it's good to prioritize making consistent monthly payments on your credit card bill and making those payments in a timely manner. Personally, if I had credit card debt, I would put a complete pause on investing and focus all of my time and energy and money into an aggressive debt repayment plan to clear down that credit card debt as quickly as possible. High interest rates are overwhelmingly burdensome, so the quicker that you can get rid of that debt, the better it is for you in the long run. Other types of debt, such as student loans, car loans, mortgages, tend to have lower interest rates. So if your debt is in these categories, then you could consider making the minimum payment on your debt, or maybe even slightly above the minimum, and starting to invest alongside that. And as a general rule to figure out whether you should invest or pay down your debt, you can compare the interest rate of your debt to the average stock market rate of return, which is around 10%. So if the interest rate of your debt is lower than 10%, then mathematically you can start to invest while you're making the minimum payment on your debt. But if your debt has an interest rate of above 10%, then mathematically speaking, it would make sense to aggressively pay down your high interest debt first, then start investing. Now that you know the factors to consider, it's up to you to decide what you want for your particular financial situation. It doesn't have to be just based on the mathematical argument. If you really want to prioritize paying down your debt, then you can definitely go for that first. But I do want to point out that you don't have to go all in just on one or the other. You can definitely do a mixture of both. And you also don't have to start by investing large sums of money. Investing small amounts does work. If you do want to invest smaller amounts, though, it definitely helps to have a longer timeline to retirement. For example, if you invest just $150 per month in an index fund that tracks the S&P 500, for example, then after 43 years, you would be a millionaire. And if you're investing smaller amounts, then that leaves you with a little bit more room to continue chipping away at your debt. And you could even consider getting a side hustle like food delivery or starting a digital download store, anything that you want to consider to earn more money to prioritize paying off your debt as quickly as possible. Comment down below and let me know if you're going to be choosing to prioritize paying down your debt, investing, or some combination of the two. If you like this video, give it a thumbs up and subscribe to my channel for weekly personal finance content. And if you need guidance on investing, click the video on the screen for a step-by-step tutorial to purchasing index funds. Thank you for watching.